Hello, everybody, and welcome to Crypto CFO's Water Cooler Wednesday. Today, we're going to be talking about crypto IRS non-compliance. Brian's going to kind of lead this discussion up today, and we'll also kind of touch on some of the opportunities that are going to arise or are already arising from the vast non-compliance around the globe, and specifically in the states and with U.S. non-compliance. So, Brian, why don't you kick it off?
Okay, so we're going to discuss IRS enforcement initiatives, narrowing them down to how they relate to crypto, and then we'll get into ways that accounting, finance, tax professionals can seize the opportunity to help clients get into compliance. And when we say non-compliance in the title of the slide here, we're only talking about the IRS for today. So I'll just breeze through about 10 slides, 15, 20 minutes, and then we can get into the general conversation. Next slide. Okay, so this is an excerpt from the Inflation Reduction Act of 2022. There's no other mentions of digital assets in the act. However, this is what gets us on the radar in the crypto industry. So under the section for enhancement of IRS resources, looking to the enforcement subsection, you can see they set aside funding for investigative technology for the criminal investigation division and to, and I quote, provide digital asset monitoring and compliance activities. So what does this mean? To us, it means the IRS is going to have the resources and technology to detect non-compliance and digital assets, and they intend to audit or investigate taxpayers who are not reporting or improperly reporting their crypto assets. So that's how it started. Next slide. And this is how it's going. So this just dropped last week on April 5th. This is the strategic operating plan that they put together to follow up on the Inflation Reduction Act. And I've highlighted the parts that are relevant to digital assets. So Objective 3 reflects a desire to expand enforcement on complex returns with high dollar non-compliance to include digital assets. So key projects in their relations to crypto or digital assets are listed on the slide. They are basically going to staff up, tool up, train employees, develop processes to analyze crypto transactions, rapidly audit them, and adjust audit procedures as they learn, or in other words, increase enforcement pertaining to digital assets. Another item mentioned in this report was a 2024 milestone, which is new analytics-enabled capabilities developed to support digital asset compliance. And also slated for 2024 is the new digital asset reporting requirements in general. Next slide. Okay, so we're not here to get into the details of the $80 billion plan, but we're just going to discuss it as it relates to crypto assets. On Thursday last week, the IRS commissioner said, quote, the IRS has no plan to increase the most current audit rate we have for households making less than $400,000. But the part I don't clearly understand is that 47 billion in magenta there is to expand enforcement on the wealthy, which is, I guess, people with households making more than 400,000, but it says and businesses. So to me, business could be anybody self-employed on a Schedule C, whether or not they make more than 400,000. So that's kind of yet to be determined. So the colors that stand out the most here on this allocation of funds that I got from Bloomberg Tax are obviously the magenta, the 47 billion enforcement. The gold color is for cutting edge technology to the tune of 12 billion, and green is 8 billion to staff up. And the IRS projects growing their workforce by 45% by the fiscal year of 2025. So these types of spending are all things that they would need to better target the crypto industry and crypto non-compliance. Next. Okay, so also in the funding was money for the criminal investigation division of the IRS. And there are a few items on their annual report that are pertinent to us. So in fiscal year 2023, CI will establish the Advanced Collaboration and Data Center, so the ACDC, to modernize its investigative practices, providing centralized access to data and resources to help deter tax and financial crime. So the ACDC will analyze cryptocurrency, tracing, monitoring, tax basis calculating is what their mandate is. Also, they're looking at the dark web and social media. But what really stands out to me is that, they're going to develop the tools to look at your tax basis, and that's going to be the basis for audit. So also the Bank Secrecy Act, BSA, is administered by FinCEN, which is the Financial Crimes Enforcement Network. And that's the source of 16% of all CI investigations. So CI uses data analytics software to take a look at what's been filed through the BSA e-file system, and that's Form 8300s. So 8300s come into play January 1st of 2024 for crypto. So if you have digital asset transactions generally in excess of $10,000 in fiat, then you're going to have to report that somehow. That's yet to be determined, the mechanics of it, but we'll have a whole comprehensive training on 8300s when the time comes. But that's going to be one way that the IRS flags people. Next. Okay, so what's wrong with this picture? So the Pew Research Center put out a report that 16% of the American population had invested in crypto assets by September of 2021. So we got that data point. Now, TurboTax Trends Report from 2021, they looked at 16 million returns, and only 2.9% of returns overall included taxable crypto transactions for 2021. And then there's an IRS publication that lags. The 2020 publication just came out like this past November. So they usually come out in November. So we won't see 2021 data till November 23. But it's IRS publication 4801. So I got that little image there of the top of the 1040. That's straight from the IRS's publication 4801, Statistics of Income. And you can see the virtual currency checkbox. The IRS reports that 2.3 million people checked yes, 157 million checked no. So only 1.45% of people who checked the box said that they had disposed of digital assets. 5 million returns were filed in 2020 with neither box checked, even though the instructions say you must check a box. So those 5 million people, I'm thinking some of those 5 million were saying, I got crypto, but I'm not going to check no because I have crypto, but I don't want to check yes either. Probably a large portion of those 5 million are non-reporting, non-filers. So, connecting the dots between the Pew Research report and the amount of people that check the box, the numbers don't make sense. Also note that TurboTax gave some demographic info, and they said inclusion varied by age group. At its highest for single filers, 4.5% in the 25 to 34 age group included taxable cryptocurrency transactions in their returns for 2021. So the question is really how many have invested in digital assets, disposed of them, and did not report it. Next. Okay, so this was something we put together as part of our premise when we developed the Crypto CFOs community, and this is what we think compliance should look like. We made some rough assumptions. So those include that since 16% of American adults purchased digital assets by September 2021, according to our research report, 16% of Americans will have had to check the yes box by the end of 2022. And we're saying that because of the short holding periods related to crypto, and because since September 2021 all the way to the end of 2022, definitely more than 16% of people dabbled in crypto. So we're just going to assume it's 16%. So there's 258 million American adults. So 16% of that would be about 41 million people that would need to check yes in the digital assets checkbox. We assume everyone who checked yes must file a tax return. Most likely they must. So the number of returns filed relative to the number of American adults in 2021 was 65%. So that's 168 million out of the 258 million adults should have filed a return. So we can say that of the 41 million who are required to check yes, 65% or approximately 27 million will file tax returns. So we use data from the 2021 tax season because there were some stragglers at the time when we gathered the data. The 2022 season was still going when we pulled this together. But if you also assume 50% of individual returns were prepared by a tax professional during the 2021 tax season, so that's 84.5 million out of the 168 million total, then you come to realize that half of the 27 million adults with yes checked, or about 13.5 million returns with crypto assets, will be filed by tax professionals. So that was kind of our conclusion. So we believe that just in 2022, or by 2020, the end of 2022, there should have been 13 plus million tax returns with the digital asset checkbox checked. And then we also have on here, I'm not going to get into the details, but we assumed from some data I gathered that it's about $438 for a 1040 with a 8949 Schedule D for crypto. So that would put us at $5.9 billion worth of tax prep work that would have at least some reporting of digital assets on it. And clearly we're not there. Next. So as I said, our assumptions of what should be are far from what is, and we got some evidence from a recent CoinLedger survey. So the sample size was small, but you can see that they found 58% of investors said they reported crypto on their taxes. Meanwhile, 31% said they did not report crypto on their taxes, and 11% declined to answer, probably because they didn't report crypto and didn't want to admit it. So 50% of the investors who did not report their crypto on their taxes said the primary reason for not reporting was, I haven't made a profit on cryptocurrency. 18% didn't know they had to report it. Another 12% didn't understand how. 7% didn't want to pay, while another 4% thought the government won't know. And then 4% complained that they didn't have the tools or couldn't find a knowledgeable accountant. Most crypto investors were unable to correctly identify taxable and non-taxable crypto transactions, with only 38% of investors able to correctly identify crypto to crypto trades as taxable. 59% of crypto investors said they were prepared for tax season, while 41% felt unprepared. So we've got a lot of opportunity to help people out here, which leads me to the next slide. So opportunities for accountants, tax pros, and basically anyone who can do reconciliation work on the blockchain. I came up with 10. I'm sure there's more. So you can assist non-filers, non-reporters, help them get into compliance. You can do analysis of prior year returns, proactive amendments to correct erroneous returns, and address the rampant underreporting of crypto. Reconciliation work of transactions on and off chain to produce accurate Form 8949 Schedule Ds. I mean, you don't need to be an accountant to do that. Identify tax loss harvesting missed opportunities by those 50% on the study who didn't report because they had losses. They might be able to recoup some of those, some of their tax that they paid by taking these losses. Generally, they can take $3,000 in short-term losses against their income. They can We can provide guidance to clients who had losses due to fraud or failed exchanges. We can represent audited clients before the IRS, resolve IRS issues, do penalty abatement, address liens, levies, do offers and compromise, tax planning, sales tax compliance, help clients with best practices to keep their crypto assets secure, and more. And I got Homer over there with his mop because someone's going to have to clean up this mess. So as you can see, you can make a whole career of this colossally underserved space as it goes from messy and unregulated to a more widely adopted and mature industry. And in conclusion, on the next slide, so basically, in a nutshell, millions have not reported, not complied with tax laws, or improperly reported digital assets in prior tax years, and this trend is continuing this year, and we're still early in the game. We estimate tens of millions should have reported digital asset transactions by the end of this tax season, but many haven't. The IRS has the tools, staffing, and the directive to find these taxpayers and audit them. And if clients find us first, or we inform the public, we can help clean up the mess and even find them tax savings that they missed out on as, crypto CFOs, accountants, tax preparers, bookkeepers, blockchain geeks, whatever you want to call it. And
yeah, that's awesome, man. Thank you for putting that together. I think that this is just highlighting the absolute crazy underserved need in this space. And I think that you'll see a lot of people this year who want to reap the benefits of tax loss harvesting for 2022, and may overlook the fact that they actually purchased that in 2021. And I think that there's going to be a lot of investigations or IRS looking at people's returns specifically because either they report that they had a long-term capital loss in 2022 and they didn't check the box in 2021, or the IRS received a 1099 in 2021 and then that person didn't check the box and then they happen to report the losses in 2022 or what have you. I think there's going to be a lot of scenarios like that. And it's just low hanging fruit for them, right? Especially if someone's if someone's seeming to have a larger balance in crypto just based on the 1099B or whatever that they receive from, let's say, Coinbase, it makes it really easy to come after people if they're not checking those boxes. So most U.S. citizens have interacted with some form of KYC exchange. And most of them are interacting with those like Kraken, like Coinbase, who do send out 1099s. Now, those aren't fully accurate and they don't have the complete data, but they have some data. And so the IRS knows if you did have crypto, most likely, and if you didn't check that box and you had significant crypto, they're going to come after you first. So I think this is a really important thing to focus on. And like Brian said, you can make a whole career out of just this one aspect. You can make a boatload of money. I think that it's an important thing to highlight. Yeah.
Yep, I'll let you know how it works out.
Yeah. I mean, get your popcorn out, right?
I think CJ and I are going to clean up some crypto messes and handle the IRS for some high net worth clients in the next year.
Yeah, we just need to get your voice trained, Brian, for some AI, so that you don't even have to sit on the calls now and just train your knowledge and your voice.
It'll sound better than me, I'm sure.
Good stuff. Yeah.
One thing that was interesting to me, again, everybody on the call knows I'm just a marketing guy here, but it was interesting to see that there's very important roles that need to be filled in this space, and you don't have to be an accountant, you don't have to be a tax professional. These are things that you can jump in, and it's interesting for me because in the crypto space we see all these like side hustles and ways to make money and things like that. And it's like if you're a pretty somewhat intelligent individual, you can watch some videos, join a community like this. There's ways for you to jump in and make additional revenue streams on top of what you're doing. And if you are an accountant or a tax professional or anybody in the space, like we were saying, this is things that could add on to make you more unique in the space. So this is an additional service that you're offering, and then you can kind of just build out your client base and just see where the money's flowing. If there's more money towards representation, if there's more money towards reconciliation, you know, whatever's working best for you, you can find your way that way. So it was really interesting for me because without the knowledge that you guys have, I just looked at it like, oh, I have to be a CPA, or I have to do this, or I have to do that in order to get into the space on this end. And that's not necessarily true. You know, I can navigate Etherscan and, you know, certain platforms like that. So that opens up an opportunity for someone like myself who could just kind of navigate those things to make money in the space, or provide assistance to somebody, you know. So if there's somebody, you know, on your end that understands how wallets work, understand DeFi a little better, understand how to navigate the blockchain, they could actually work with you, for you, to help build your practice to make you more successful on that end. So that was my biggest takeaway from that side.
Yeah. So
Yeah.
only a CPA, an enrolled agent, or an attorney can represent somebody before the IRS. So if they're spending all their time dealing with the IRS, they're going to need someone who can do the reconciliation work and the accounting work and clean up the mess while they handle the IRS. And when all these audits come, what these 1040s are going to get audited, because the stuff that the information the IRS gets with all their new tools isn't going to match the shit that people put on their you know, their tax returns, because they just handed their tax preparer incomplete information. Tax preparer doesn't understand, you know, that they need to get the whole picture, and they just put down what they got and move on. So they're not going to be able to represent those clients because they don't get it. So there's going to be a ton of work for whoever's dealing with the IRS and whoever can support them. And you don't have to be an accountant at all to figure out cost basis data on the blockchain. I mean,
Yeah.
most people, DeFi degens, as you guys call them, are probably figuring out their own cost basis when on everything they do, or you know, or giving the wrong information to their accountants.
Well, I mean, and a lot of accountants, like I just responded to a comment in the crypto tax subreddit a couple of days ago where this guy was like, my accountant refused to use the 8949 that I gave them from CoinLedger or whatever crypto tax software they use. And they were like, no, you just need to send me the 1099 that you got from Coinbase. And I just was like, your CPA is grossly uninformed. The 1099 is absolutely incomplete, because the fact is that these exchanges that are sending you these, they are only obligated and they only have visibility into your transactions that happen on their exchange. So if you had any transactions at all that were DeFi related, that were in a non-custodial wallet, that were on any other exchange, that information isn't captured on that 1099. So effectively, that 1099 is useless to us as tax preparers in actually reconciling your crypto taxes. So it just shows that like accountants and CPAs in this space are so behind on what's going on that they're just giving their clients terrible advice. So above and beyond the people who are reporting, the vast majority of them are reporting with CPAs who don't know what they're doing. So even if they are reporting, they're likely reporting wrong. I mean, it's just it's a mess. And I think that you'll see resolution work with people coming from, they're like, yeah, I filed, I checked. And that's something that we didn't even cover in this. It's like, even the people who did check and file, they're likely wrong. Because either they relied on a CPA who is grossly uninformed, or they used crypto tax software that it requires us to know what's going on as well, and to change and manipulate data based on what's actually happening on chain and the actual specific circumstances of these transactions that we as the individual operating and performing those transactions know the context of. So there could be shitcoin airdrops that are included in there that shouldn't be reported, that would overstate your tax liability. There's a number of things. So even the people who are checking and filing are likely getting it wrong too. So, you know, it's insane the amount of work that's coming our way. And another thing here is that everyone on this call is insanely early, because on our team call before this, Brandon like very astutely mentioned that like we're trying to launch this community in a down market, right? We're in a bear market right now. So when you look at the halving cycles, Bitcoin is about to go on another halving cycle in Q1, early Q2 of 2024. So about a year from now. And if you look at the charts, every 4-year cycle spurs a bull run. And when that happens the next time, you're going to see a wave of interest and everyone's going to be trying to catch up. And everyone on this call is going to be leaps and bounds ahead of all those people. And you can say, I've been in this industry since, since the last bear market. I was learning this stuff in the bear market, right? So I think that just keeping this all in perspective, the opportunity is insane. It's a blue ocean of opportunity. And I think that, yeah, it's exciting. That's why I like this industry. It's like, we're in the Wild West right now, and hopefully we get more clarity on regulations and things like that. But even if we don't, you're seeing the de-dollarization globally and all that stuff. So, if the dollar loses its position as the reserve currency, which is likely to happen, maybe not overnight, but you see the BRICS nations are starting to coordinate. Maybe Bitcoin becomes an opportunity for a reserve currency or something like that. So go ahead, Alvin.
Yeah, so one thing I noticed when Brian was giving the presentation was the inclusion of digital assets in for the filing of 8300s. So basically, they would include it with cash and cash equivalent, so $10,000 or more. So that when I saw that, that means that that's possibly ongoing work too, because it's like 15 days if I'm not correct, if I remember correctly. 15 days after the transaction crosses that $10,000 threshold, you have to report it. So if that's included with the 8300, that's something that's going to have to be ongoing as well.
Yeah, that's a really good. Yeah, go ahead, Brian.
It's supposed to start in 2024. I don't know if they'll be ready. I mean, so the 8300 is going to have to get revamped, because when you think about an 8300, right? It's basically US dollars in the United States, 99% of them, right? Sometimes I do some with money orders. I filed 1,000 of these things for cannabis. But I realized that they won't work. The current process won't work for crypto, because how do you know with the way it works now, you have to verify the identification of the person who hands you the money, right? So you look at their license and make sure it's the person, or or their passport or whatever it is, right? Or even if you don't have it, they can like send you a copy of their license. You see, you know who you're dealing with, right? But how are you going to do that when it's an NFT bought that a stranger is paying you for, and they're in freaking Uruguay? You know what I mean? Like how
you don't even know. You may not even know, because you did it on a decentralized exchange. So you may have no way of knowing.
So like they really need to come up with some new instructions entirely for what information is required, because the current process just won't work for crypto.
Yeah, I think that did cross my mind, because I also was wondering how would we figure out the value of the asset, of the currency and everything like that, to know whether it reaches a threshold and different things. So that was really interesting. And just a quick other question I have, as you know, as I said, I just soak in a lot of the stuff here. So basically, what would you think is the best approach? Usually, like if you're working with a new client and you recognize that they possibly have problems with their filed returns, past returns that's filed. In this space, and in this case, as we can see, it's millions of people based on the data that we just saw. Would it be a situation where, okay, we're gonna go back into the past and make sure that we get, we file amended tax returns and everything like that? Would it be a case where we're just gonna show them the value of what we can bring now, and then, go back or is it like a case by case basis?
Definitely, it would be a case by case basis, I would think. And I think that, a lot of these instances where people reported crypto assets in the past, they could be vastly over-reporting just based on the stuff that happens on chain. Like I mentioned shitcoin airdrops all the time. Like people can just send you coins and they can falsify or manipulate what the price actually looks like on chain, where it's not actually legitimate. So You have to, you could investigate stuff like that, and you could kind of take it from the approach of, hey, I believe that based on like looking at some of your transactions and some of your reporting, especially if the client feels like, hey, I reported that I made all this money on crypto last year, but I don't really think I did. Can you take a look at it? Or I would just ask them a string of questions. We do have a client intake checklist specific to crypto in our work papers that we can pass along to you, Alvin, of questions you might want to ask clients. But yeah, I mean, I would ask them, did you have crypto? If you see crypto on their return, like this year, for example, you can ask them if they had it before and they didn't report, because you can look at the checkbox on prior years to see if, and in that case, you should advise them to file that, assuming it's going to materially change the return. If they made $12 on Coinbase, like maybe you don't file an amendment, but I would definitely bring it to the client's attention. I mean, Brian, what do you think?
I mean, you got to look at Circular 230, right? And then it tells you what to do for when you're pretty much supposed to amend anything to get it right before you do the current year return if you identify something material that's wrong. But the order you do it could be different, right? You could take care of the current year first and then go back and address things. Or the IRS can fix it for you, right? If they get their new AC/DC technology room and go sweep the blockchain, and then they just send you a bill. That's going to happen too.
Yeah, because I mean, ultimately, there are forensic accounting firms that already exist and can already capture all this information. It's just the IRS doesn't have the resources to go out and leverage that information yet. So I would just inform your clients that, like, even if you're not reporting and you think that the IRS can't handle this because it's complicated, the IRS, even if today they can't handle it, they will be able to handle it. And if they see that you're materially underreporting willfully, they can basically extend the statute of limitations indefinitely. So I think there's no question that you should inform your client that, like, especially if it's material, you should go back and take a look at this and amend if necessary. So yeah, I would just, if any client coming through your door has crypto transactions, and I would ask them too, even if they don't have it, showing up on their return, look to prior years to see if they check those boxes and ask them those questions. Because if you get into the reconciliation process and they hire you to do the reconciliation, if they had transactions in prior years and they don't give you that information, it's going to be apparent to you because the math won't work. Like, they'll have money that they're sending out that came from nowhere, and it's like, it's all on chain. So that, the second you start to investigate transactions that they provide to you, you can easily see if they went back. And like I said before, almost I would say 99% of Americans that have gotten into this industry are KYC'd on some exchange. So that means know your customer. They've provided a passport or a license or something. So they've been identified at some point on chain. I'd say the vast majority of people. So like I said, with these companies like Chainalysis that can provide this data and can track people down very efficiently and effectively, the IRS is going to know at some point whether you underreported or failed to report. So super important. Great question, Alvin. Super important to tackle this for clients because they're opening themselves up to fines and penalties and potential, like maybe criminal penalties depending on how large of a underfiling it is.
Another thing I was just thinking about. So if you're the IRS, right, and you look at when I had the 5 million people in 2020 didn't check the box. Let's say 2021, everybody who sold in 2021 was probably up at the time. So if it's an up year for crypto, the IRS is probably more likely to look at an up year than a down year. So if they look at 2021 and let's say there's another 5 million people that didn't check the box, now you say how many of them earned over 400,000? Maybe it's 2%. So maybe you got like 100,000 people that earned over 400,000, didn't check the box. Now they take those 100,000 people, bounce them off the blockchain. 16% of Americans own crypto at some point. Let's say 16% of them 16,000 people, automatic audit for those 16. They're on a list. Audit those 16,000 people that had crypto, didn't check the box, and earned over 400,000. Like it's going to be pretty easy for them to determine who they want to go after. Look, you're muted. You're muted, Taylor.
The combination of AI plus data chain and on-chain analytics is going to just make this so easy for the government to determine. And yeah, I mean, it's going to be like shooting fish in a barrel for them.
I think we need an advertisement with the IRS shooting fish in a barrel.
Yeah.
Join crypto CFOs.
That was a good one. Yeah, I mean, I think that this is an important topic, and I think that, like, yeah, like we say, it's I can't stress it enough. This is a wave of shit. This is a shitstorm coming, and a lot of people are going to get caught in it.